Good morning, ladies and gentlemen. Well, just when you thought that the risk dial couldn't get any more bullish, here we go, 95 brand new highs. I've checked and the highest it's ever been is 98. So we are as close to perfection as we could possibly be. I think these moving averages are all going out. I think this is going to last a while longer, but I will naturally look at it all in more detail starting now. What is the yield curve doing? Well, stable to flattening. These are the twos, tens. As you can see, we have topped around that 160 level. We never got to my 175 level. And here we are. I think we are going to have very good support down at 126, 127. And that is probably where we're going to go over the course of the next 2 or 3 weeks. I expect it to trade basically between this kind of level, 147 down to 127, so 20 basis points of flattening overall. And I will show you the implications of that for the European spreads, for the European rates. But the US yield curve basically now is in a corrective phase, and we can see that in the 5s, 30s and in the 30s, 10s. It's all basically coming in, and that indicates a level of stability in fixed income over the next 2 or 3 weeks before the next kind of storm can hit. Here we have the weekly 5s, 30s. If I enlarge it, I think that we are basically now stuck between 140 and 154. Waiting for news, waiting for inflation, waiting for unemployment. It's going to remain quite neutral for the next several days or even weeks. As you can see, getting out at 140 was the right thing to do. Looking to put on the position back on at around the 154, 155. I really don't think that we will steepen over the course of the next few weeks. If we look at this is the 10s, 30s, to me that is a very good indicator of what kind of inflation scenario we are expecting. And that basically has been very stable. Getting out at 64 was absolutely the right thing to do. And I think basically we will just meander around this 72 area. That shows stable inflation expectations, i.e. nothing better than we have already penciled in, but no great panic that we are just about to get much more inflation. Until that moves out of this range between 64 and 80 and closes a couple of weeks below it, we will not know what the market is expecting. I expect eventually that we break up in the 30s, 10s, simply because I think the Fed at some stage is going to have to start tightening or not doing extended QE, and that is going to flatten the curve at higher levels. But this is still very much down the road. The individual tenures did slightly better last week, nothing to write home about. This is the 5-year note, the yield on the 5-year note. We just are unlikely to move a million miles away from 80 basis points. There is absolutely no reason to believe that the Fed is going to ease or that things are going to get much better. So I would have thought that this kind of behavior that we had here is going to get repeated. I really wouldn't get excited on the downside in rates in the States. I think at some stage the pressure will return on the 5s and 10s. less so on the 30s, because I don't think that there isn't that much inflation news or inflation scare that would hit the 30s as opposed to the 5s and the 10s. If we have a look at the 10-year note now, you will see that I expect it to basically do this kind of period. I really can't see it below 139 basis points in yield, and I can see us over the course of the year going back up towards 185 to 2. Simply because it will become clearer, it should become clearer towards the end of the summer that the economy is doing great things and it's going great guns. So I really wouldn't get fooled by days like we had over this week, couple of days, Thursday in particular, when yields came off. They will come off, but they will go straight back up. I think we're in a period something like this, and that actually is not bad for risk assets. That's all that can be said, that we are in a trading range. I really don't think that we can bust through 139 on the downside in 10 years. What is very interesting to me is that shorts in fixed income seem to be migrating from the US to Europe. This is a chart of Germany 10-year against US 10-year. And you can see that all week we came off. So this resistance at 197 basis points, or even 190, 191 basis points, I think is going to be very, very significant over the course of the next 2 or 3 weeks. And that slowly the market is going to attempt to trade 175 basis points on the differential between Germany and the US. Now, what does that mean for the US curve? Let's go and have a look at the bobble. The bobble is the most stable. As you can see, it's basically doing nothing, but it's doing nothing at higher levels. And it's trying to close the week above 61 basis points to head towards minus 52 basis points. But it's waiting for the ECB, it's waiting for signals. If we look at at German bonds, now this is a monthly chart, and I've put on the monthly chart because I want you to see how important this minus 22 to minus 17 area is. We haven't been above it since 2019. Okay, so any monthly close above there, and I think that we are going up here into the 20s and 30s in terms of yield. If we now take that down to the daily level, let's have a look. It's still much the same picture. We really have to close above minus 21 and then above minus 17. Are we likely to do that? Not before the ECB. I think we need some signals from the ECB that they are prepared to tolerate higher levels of long-term rates, and I think we are beginning to get some jaw-boning about it. I still think that the risk-reward in holding bonds and being long of bobble bonds, Italian bonds, French bonds is absolutely horrific. Because if we are very close to a bottom in US rates during this retracement, and we are going to 175 basis points on the differential, at any stage we could get a real spike in bond yields. Let's say that we have 150 if we stay 150 to 170 in the 10-year note, well, that would take us, if we go to 170, that would really could easily take us to zero in German bunds, with a differential around 170, 175. So there's so little that makes sense in being long of Germany or BTPs that it's a horrendous risk reward. And I have a couple of trades in options which I think make sense to capitalize on that spread and the potential for that for the move in Germany to be up towards zero. If I'm looking for the spread between Germany and the US to come in terms of interest rate differentials, then I have to be bearish for the dollar. And the dollar has duly reversed with the trend in rates, and now we have support at 91.01 on the weeklies, and then really I'm looking for it at some stage during the summer to start heading down towards 88.44. If we have a look at a daily chart, we have really reversed fantastically well at exactly the trend line, and we're now following the 200-day moving average lower. I don't think there's, we achieved perfectly the objective from the ABC retracement. I think the primary trend is now about to reestablish itself. I think any move back up towards 92, 92.40 is going to be a wonderful opportunity to sell dollars into the summer. If we have a look at what that means in terms of Euro USD, I mean, you can see where Euro USD stopped last week, exactly at my 119.88.5 level. It's opening up the Bollinger Bands, a couple of days of hesitation and filling, and I think the chances are that we start going up towards the mid 120s. I am very bullish for Euro USD. I'm very bearish for the dollar. It's done nothing wrong really. This period of consolidation on the weeklies that we can see better here is really a what you would expect from a healthy trend. It caught the moving average, the 200 week moving average, very beautifully. The Bollinger, the stochastics are about to turn on the weeklies. A few weeks of sideways, and I think we then go up towards 124, 125. The target really becomes 124.53 over the course of the summer, but I think it's going to be a period of weak dollar. What are the implications for gold? Well, last week I said that if we could close above 1764 on the week, I would start getting impressed. What is, it's the dollar, and also bonds had a bit of a better week. I'm not expecting that to continue a million miles, but I am expecting a weaker dollar over the course of the summer. So one of the two components of gold is working in its favor. What does that mean? That means that I think it can probably push now to these kinds of levels, 1820s to 1830s. I don't think it goes much more than that, simply because, it could even test this 200-day moving average on the dailies. But anything above 1820, 1830, I think is probably overdone, because bonds are not going to be helping, not very much, and the dollar will only go that far. So yes, certainly impressed that it's probably going to do some kind of an ABC with some targets higher up, but it's not going to be anything hugely exciting. If we say that is the ABC, Where does that take us? Here it is, 1810. I think it's corrective, and unless the dollar starts gathering steam, which I don't think it will, because the ECB is not going to be very happy with it. I think the dollar weakens, but it weakens marginally. We're talking about 2-3 percentage points. That is all you're likely to get, this kind of move to the 1810s, 1830s, and then you abandon gold again. I also wanted to show you a chart of DBC, which is a commodity ETF. And it's interesting because I think it's doing a final fifth wave that will see it up to 1841. So that is, what is it, another point? So that's 5-6%. So it's looking like it's going to have another period of new highs, which in itself is going to hold bonds in check in terms of rates are not going to come off during that period. Some people will be getting bearish into it in terms of rates because of, you're getting a new high in the DBC, the commodities, and that is a confirmation of my slightly bearish view on bonds and the fact that gold could go up another 2-3% together with this commodity index. Well, what about SPX? It's on a stairways to heaven. This is the 195-minute chart, as you can see, and basically it's one-way traffic, isn't it? As I said, don't try to sell it. There's absolutely no point. It's going to go further than anyone thinks possible. The only problem is that it all lacks definition. And really, there is no real support until 40.68 in SPX. Okay, sure, there's going to be some support here around 41.33 or so. And I think that is all that we are likely to see over the course of the next few days, i.e., quick 30-40 points, maximum retracements, and then a continuation of this kind of stair-stepping. I really don't see how they're going to, why they would sell it ahead of the big earnings in the US. I think at the end of the month, or between the 25th and 28th, I believe, we have Amazon, we have Apple, all the big ones, the FANGs. Until then, I think it's unlikely that we have a very steep down day. I think the market has to get people long at the wrong levels before it can reverse very strongly. It will do, because there is absolutely no definition on any time scale that you look at, whether it's the daily, the weekly, or the very short term. There's so little definition to this move up that at some stage it's going to retest it, retest the breakouts. But until it does, and it'll become very clear from the action in volatility when that is, I believe, there's absolutely no point in fighting it, because it can go quite a bit higher. If we have a look at the weeklies, it's basically just continually outside the Bollinger Bands. I'm asked, how long can that last? Well, it can last a long time. We've now had 1, 2, 3, 4 weeks of positive. Here we have 1, 2, 3, 4, 5, 6. In other places we have 9. So it could easily go on another 3-4 weeks before we have any kind of major retracement. But we know where the major retracement is going to come back to, and it's going to be at least 40.75, which is the level that it broke up through the Bollinger Band, or more likely is going to be just below 4,000 to this 3,940 level where it broke out from. That's what the market does. It tends to come back to this 25 period EMA, and in 3-4 weeks it'll be up here and the market will come back and do that. So I'm absolutely very content with keeping long positions and not being hedged. I now know when and how I'm going to hedge, and really volatility is going to tell me. This is volatility, and basically I think it's amazingly clear that when it hits 1558, it's time to buy 1.5 to 2 month puts just to have them there as a hedge for your portfolio. It hardly ever spends more than 3 weeks underneath 1558. If it does, it tends to go to 1197, but that is such small differentials in the price of the puts that it doesn't really matter. To me, 1558 is the level to start hedging longer term portfolios. You get all the benefit of the upside and none of the dangers from the downside. It'll be as cheap as chips to hedge a portfolio at 1558, and I will tweet to you on Monday or Tuesday how I intend to do that. Before looking at NQ, I just want to show you how technology is not providing any leadership at the moment. None of these charts are doing anything. We are basically meandering in what we have been doing since August or even July of last year. This is the spread of the QQQ against SPY, and basically it's doing nothing. With rates it came off, with rates it's done slightly better, but all it's doing is hugging these moving averages and looking for the next inspiration from A, rates, and B, the earnings of the big tech companies. Given that is the situation, it's unreasonable to expect NQ to do anything much than be a market performer. And yes, one day it'll outperform, the next day it will underperform, but basically it's doing whatever SPY is doing. So when it gets to extremes, you don't want to be in NQ, and you want to return back to SPY. It's basically, that is all that's going on, and I don't think it's going to change in the next couple of weeks for sure. Given that, it makes no sense to be trading NQ if it's a market performer when it has much higher volatility and it has therefore much higher danger on the downside. I see absolutely no point in trading it. I'm gonna stick to SPX because I see no trend in rates that would make NQ be a better performer at the moment. So really, if I'm looking for a 1.5% upside next week for SPX, I'm not really looking for much more from NQ. To me, the danger of in NQ over SPX are just too great for the small difference in volatility that you are getting, and therefore I would much rather leave it alone. In terms of levels, 14,132 on the upside is your first level, and after that it'll be somewhere in the 14,500s. But as I said, it's not bearish, but neither is SPX bearish, and I think it makes much more sense to trade SPX than it does to trade NQ. Europe is doing fantastically well and should continue to do so for, well, the foreseeable future. I still think EWU, which is the UK, trades at least 34.10 very shortly and ultimately up towards 38. And this is the DAX. This is a very long-term trend channel on the weeklies that's held since I don't know, 2003 or something. And basically it comes in around the 15,700 level. That is obviously, I think, where we are going. The the thing that I'm struck by is that we have broken this area of consolidation in Europe, which has been lasting, like you can see how long, basically 2014 to 2021, 7 years. You would expect this market to be doing relatively better. You would have thought that over the course of time it's going to get to 44,512. So the allocation to Europe should definitely be there. Are we very close to these trend channels, just like in the DAX? Yes. Where does that come in? 4,000 and just above 4,100. So still another 3 to 4 percentage points away. And that is really not, unbelievable that it can happen over the course of the next couple of months. I wanted to show you these spread charts of EEM against everything else. This is EEM against Japan, against Germany, against Europe, i.e. the stocks, and here against the States. This is basically the weakest we've been since, this is basically, let's go here. This is the June of last year. And I think the risk reward at this level much favors EEM rather than the US. I think EEM can have a spurt upwards while the States go sideways. But what's important is that if the theme is going to be a weaker dollar and stable-ish rates in the US, that very much favors EEM and also favors Europe. But I mean, if we have a look at this chart of EEM against Germany, if we are positive again for Germany, and we are very, very close to a trending move higher towards this line in EEM against Germany, you really have to start getting bullish of EEM again, or certainly having some call spreads, and I can tweet to you that on Monday. This is now the EEM chart. I've kept on saying sell puts 5208 to 5023. It's doing nothing wrong, but it's doing nothing right. And I think it's just about time to allow it to do something right as opposed to do nothing wrong. I think you could easily now trade 55.83 and possibly higher over the course of the next 2 or 3 weeks. I think I'm returning to be in favor of EEM rather than the US. I also want to make you aware of the Nikkei. It's done absolutely nothing for 10 dozen weeks while the US has gone straight up. And I've also, and I can show you to you again, this chart here is the spread of EEM against Japan. You can see how basically EEM Japan has been flat around this longer term moving average. It's been doing very, very little. So now if I'm expecting the EM to start doing better, it's really going to be incumbent on Japan to also push higher. And I think that any close above 30,250, 30,300 is going to be an indication that Japan is breaking out as well, and that it will be double confirmation that EEM is going to do quite a bit better, certainly against the SPY. In summary, basically, I think over the course of the next week or so, we go down towards support at 127 basis points in 2s, 10s, and 140 to slightly better in 5s and 30s. That should lead the dollar lower, and I'm looking for it to trade 91.01 now. Any spike into the 92s, I'm really, around 92, 92 and a quarter, 92 and a half. Again, I'm a big buyer of euros and seller of dollars. Gold, I think 1810 to 1830 is now likely. As I said, it closed above 1765. You should give it a chance. Trading it to the upside from 1765 is probably not a bad idea. But if bonds are in a range, as I showed you, and the dollar's going to go down, I think 1810 to 1830 has every chance of being seen. SPX and NQ, much of a muchness. What is the upside? It can do more than 4,200. But for the time being, I really don't see anything lower than 41.32. It's weak support, but I don't think the market, until we've seen these earnings and we've got people long at really bad levels, I really don't think the market is going to come off. EM has a chance. 55.83 is where I think it goes next, and quite quickly. And these markets with the ECB next week are going to be very, very interesting. I showed you the weekly chart of the monthly chart of the Bund, and how important these 26 and 22 to 17 areas are, minuses, of course. If we start going through it because the ECB does something unexpected, the move could be quite large. But in any case, I think 10s US against Germany is going to 175 over the course of the next 2 or 3 weeks. And that is still a good move. That's still about 20 basis points. So I'm really looking forward to trading that one. Thank you very much indeed, and tweet you on Monday.